So finally, there's to be a UK election before the end of the year, but will it resolve anything around Brexit, and what should the markets make of it? Well, John Ashcroft joined us now from the Saturday Economist. John, welcome. Thanks indeed for returning to us here at IG.
Good morning.
Any more clarity in your mind now we've got an election lined up?
Yes, the clarity has emerged from the mists of time, and we now see that we were worried about Trump and tariffs, Boris and Brexit. Now we add in impeachment in the US and an election in the UK, so what can go wrong?
Yeah, there's lots at the moment with the markets. Obviously a lot of question marks about where we go in the markets. But let's take a look in some more detail about Brexit and how things in your mind are going to be mapped out. Should you be encouraged by the fact that Labour have come on board? Is there going to be clarity out of the election itself, or do you still see that the market should be cautious about the outlook for Brexit?
Well, I think the markets will be cautious because there will always be uncertainty surrounding the outcome of the election. At the moment, the polls look as if Johnson and Powell are going to romp home with a big majority. But it's early days. When the catfight starts and the real arguments emerge, then the polls are going to narrow as we move to the deadline day. And even then on the day, we don't really know. So at the moment, it looks like a good step forward in terms of positivity, but there's a lot of doubt that will emerge in the canvass period.
I think the interesting thing that's come out in the last 24, 48 hours or so has been commentary around the amount of lack of growth that's going to be in the British economy, something like 70 billion knocked off growth every year, even if we get Boris Johnson's deal past the post. And of course, if what you say comes to pass with a Johnson romping home to victory, he's going to push forward with his deal. That's going to be the economic consequence. This surely is rather alarming, isn't it? Or do you think that's just taking the things too far to say it's going to cost 70 billion a year?
I think the problem is we don't know what the Johnson policy is, really. And we've seen evidence of, since he's been in office, a prorogation of Parliament, we have several defeats in the House, suggestions now he's not going to allow a hard Brexit, but we really don't know. I mean, there are real problems. So even if the deal is accepted as it is, we don't know what the end game will be after the negotiated period. So, okay, at the moment we want to stay. From a business point of view, we can accept we're going to leave politically. We can accept we're not going to be subject to rules of the European Court of Justice, but businesses, they want to stay in the single market, in the free trade area, and really they want to stay in the customs union. It's illogical, as we've seen with the Irish position, it's illogical not to be in the two. So you're in the single market, yeah, you're in the customs union.
And of course then those that want Brexit say, well, that doesn't deliver what we promised, and that is the opportunity for trade deals with other nations. That, of course, is a bit of a problem, isn't it? Because it's the other nations that are growing. It's not Europe that's growing. It's Brazil, it's Argentina, it's the third world.
Yeah, but I think that from a business point of view, with over half the trade going to Europe, you want to anchor that process. So we can accept it's the political decision, which political, I think, and social. Who governs Britain? Issues of immigration. Those are the issues that are driving the thought process. I don't think the voters were thinking over much about free trade deals with America or with Japan or elsewhere, because let's face it, we're already trading with all of these markets. So I think that, yeah, it's great we're going to have an election. It's great if we get a positive result. Yeah. Not so good if we get another hung parliament. Yeah. And we've yet to see what will happen in the weeks ahead. So it's going to be touch and go time. And I think that'll impact on the markets.
Well, let's take a look at the markets. This is sterling against the US dollar. In the last 3 or 4 days, we've seen a little bit of an uptick with, this is the daily candle chart, taking us up to 128.90. We've got some resistance up here at 130 and support all the way down here just before we saw that big lift off for sterling back on the 9th of October. That line of support is at 122. So we're talking about a wide band here. Any way we should be looking at this market, bearing in mind what we've just been saying?
Yeah, I think it's quite an exciting trade, really, because last time I was on, we were talking about the sterling trading between that 125, 120 band area. And I think I was saying then it would need a big push through to break through the 125, and sure enough, we had that. Good news about Brexit, or so we thought. That push sentiment really, and we surged through that 125 level, then hit 130 as a big resistance. So now you're sort of stuck between 130, 125, and I think it's going to move sideways. It's going to trade sideways for a while now until we get clarity on the election and the real emergent Brexit policy. So yeah, it's a very exciting trade. Also, last time we were saying, the last move from 125 to 140 took about 12 months or more, with 6 fantastic trading cycles through the process. And to move through 130, it took about 6 months to go through that period. So I think we've seen a big exciting uplift for the moment, and you just get the feeling that the sentiment is with sterling now. You know, the Fed rate, possibility of a Fed rate cut today, weakness in the euro and ECB policy in Europe means that the sentiment is with sterling, and that's a good thing.
Let's take a look at the other side of that trade then and take a look at the US. You mentioned as well the other things we should be discussing today as Trump tariffs, impeachment potentially. Where's that take the dollar side of the sterling dollar trade?
Well, again, it's very difficult because the US should be on a great surge because we've had incredible tax cuts from the Trump administration.
But haven't they worn through the system already? Haven't we already got to that point where we're no longer basking in the glory of all that? It's happened, it's finished, we've gone through the cycle, we've passed a year.
No, I think you get, with the tax cuts, you get a boost to earnings, which is a one-off kicker to earnings in that specific year. But then the thrill lives on. So if there's a tax cut for consumers, okay, they get the first year cut, that lives on. Tax cut for business, that means you get a surge in earnings in year one, which can push prices higher. But that tax cut lives on, and you're pushing money into the economy. So in terms of the tax cuts, they will carry on, they should carry on. And this is a myth in the markets, I think. No one really quite grasps this. So the tax cuts will live on, and the spending plans are living on as well. And the problem in the US is, you know, not for this year and not for next, it shouldn't be. There are 2 big problems emerging in the US. We've seen, you know, the borrowing deficit for the US hit $1 trillion. That's going to go over $1 trillion next year. Big increase in, still increases in the trade deficit. So what we call the twin deficit dilemma will be a big overhang for the US in a year's time, in 2 years' time. This year, we should have seen growth of 2.5% to 3%. And we're going to struggle to get growth of between 2, maybe 2.3%, I think we're seeing. So this is all primarily because of what's happening with the business uncertainty, investment uncertainty, and Trump and tariffs.
Let's bring up a chart of the S&P 500. This doesn't seem to have affected too much about what's going on there. Yes, it took a little bit of a while to burst through this 3028 level, but it's done so in the last couple of days. Here we are now just a couple of points shy of the 3040 level on the S&P 500. It doesn't seem to be too much now that's going to hold this market back, especially if there is some clarity, positive clarity, on the tariff side with the US and China.
Well, I'm not sure we can hope for that, but what we can see is both with the S&P, the Nasdaq and the Dow, they're all incredibly highly correlated, and they're all ready for the breakouts. These charts look quite exciting, really. So the markets tend to think that, you know, no matter what happens with, in the worst case with tariffs, the Fed's going to bail them out. And Trump running into election, he desperately needs a resolution of the Chinese situation. So I think, you know, the business fundamentals are still strong in the US. And I think that's what we'll see. We'll see that the markets, those look to be that together with China, maybe China 50, they're sort of 3 most exciting markets in charts in equities at the moment.
Yeah, there are some people say that Donald Trump's obviously going to make a tilt at the second term and that he will win, but at the same time he's got this long political shadow hanging over his campaign with this potential impeachment.
Yeah, there's some people who even question whether Trump will be on the ticket
in
2020 because the impeachment saga is hotting up, and that's going to get more and more difficult. And we see what's happening with Rudy Giuliani. Yep. Mick Mulvaney is chief of staff. I mean, that when you have your own guys, close guys, confessing on camera that there's been a crime committed or a misdemeanor committed, these are serious policies. So, you know, Giuliani's going to be in big trouble. Mulvaney is probably being edged out even as we speak, and Trump will come under a lot of pressure through the impeachment process.
Having looked at the S&P 500, I do want to take a look, if we can, to complete the circle and go back to what's happening here in the UK, because I think it's important to monitor as well what's happening on the FTSE 100. Now, the FTSE 100, some might say, is nowhere near the highs because we've had all the problems with Brexit and so forth, but in reality, this is an index which is outward facing. It's an international index. It has a lot of companies with a lot of exposure to the international markets. Why is the FTSE not up at these record highs near 8,000? Why is it still at 7,300?
Well, I think at the moment it looks like maybe hung parliament, also a hung index. It's looking for direction, trying to seek direction. Part of the problem FTSE faces is has big dollar exposure, so the major players have big currencies exposure. So if sterling does appreciate, that can push, that can weigh down on the index. But in general, I think the markets are waiting. So you see the same in France and in Germany at the moment. The European indices are just slightly hung. If anything, the Europeans look slightly more positive than the FTSE at the moment.
They do, yeah.
But I think at the moment the index is hung and it's just waiting for direction. So we get clarification on the election process, and then we need clarification on what the heck the Brexit deal is going to be.
And in terms of Europe, let's bring up a look at the DAX index as a good indicator as to what's happening. As you're saying, this is a real run we've had recently, past recent resistance. But of course, Europe's got a ton of problems, in fact, probably more so economically than most other regional developed regions of the world.
Yes, and in some sense that's slightly more surprising because I've seen low growth in Germany and in France, and the German manufacturing sector has been hit very badly, allegedly because of the situation in China, US tariffs potentially, and also the Brexit overhang. So I think it is surprising to see that positivity, and but that's a reflection probably that the markets are generally, the mood is good, I think, in the markets. They want to they see upward direction. You know, we don't see any real recession in the world. We see a slowdown, significant slowdown in the world, but there's no reason why we should fear recession at the moment, and the fundamentals across the world still look pretty good.
Yeah, and should companies in Germany and across Europe be licking their lips at the prospect of more quantitative easing? Because that certainly seems to be behind much of what we've seen in terms of what little growth there is around. It's generated by central bank activity.
No, my dream is there'll be a moratorium on QE and a moratorium on negative rates. So
for Europe or
for the world.
Globally?
Yeah, so there'll be a...
Why? That's the only thing propping us up, isn't it?
Well, I'm not sure that it pushes in the right direction. So the move to, we talk about life on planet ZERP, the world of zero interest rates, and also negative rates. You know, what are negative rates actually doing? And the answer is it's mispricing capital. In the capitalist society, mispricing capital, that can't be a healthy thing. So you're seeing distortions of the yield curve, and you're still seeing distortions of, for savers. So QE, negative rates, these new toys that have been discovered by central bankers, then I think they're a danger. And what we want to see is like a world convention, be it at Davos or in the desert or wherever, discussing the perils of negative rates.
Yeah, but at the same time, we've built up this enormous debt pile. You're talking there about what's happening in the States. It's not just the States where we have debt pile of that sort of magnitude. Proportionately, for us here in the UK, we're at record highs in terms of debt to capital, population. Europe, ditto.
Yeah.
That's all got to have to unwind at some point, isn't it?
Well, it can not necessarily unwind, it can be inflated away, which is one traditional resource.
Inflation, wouldn't we love inflation?
Yeah. It can be grown away by higher growth. But I think if you look at sovereign debt, then something like a third of the world's sovereign debt at the moment is offering negative yield. And what we can see is the clear correlation between the weight of QE, the proportion of sovereign debt that's held by the central bank, and the relationship with negative earnings, i.e. the higher the amount of QE in relation to GDP, the higher amount of sovereign debt held by the central banks, the lower rates are. And this is QED, not a quid pro quo, but quod erat demonstrandum of the perils of negative rates.
Look, John, we'll leave it there, but thanks indeed for joining us. Quick trip round some of the economics around the world. That was John Ashcroft. You can join John at the Saturday Economist, and you can pick up on his weekly blog with his thoughts about what's happening in the global marketplace.